So I thought it would be great to start with each of you doing a little bit of an introduction of yourselves and then also telling us what are you focusing on right now in the companies you're looking at. Why don't we start with Jaime?
Yes. Hi, everyone. Jaime Schmidt. A little about myself. I started the brand Schmidt's Naturals back in 2010. It's a brand of personal care products that I started in my kitchen as a maker and artist. Never imagined scaling it into the business that it became, but over 7 years, ended up selling it to Unilever. Since then, I've been investing in other founders, very passionate about CPG. Also, treading the waters of Web3. I started another company in the space and making some investments there. It's probably another topic for another panel. But yeah, it's super excited about the industry that we're in right now, or the market conditions don't faze me. I was a bootstrapped founder. I know what it takes, and yeah, we'll get into it.
Great, thanks.
Can you guys hear us okay? Okay, because we can't hear each other. That's the problem. I'm Jessie Draper. I run Halogen Ventures. We invest in early stage female-founded consumer technologies. We have 70 companies and have had 10 exits to date. We're super focused on the category future of family right now, which is childcare, ed tech. We did a whole study around it, and we're really passionate about kind of that space. We also do a lot of fintech investing and the consumerization of healthcare right now. So those are some of the things I'm thinking about, and I just launched a new podcast called Monumental that gives a landscape of childcare across the country. So we're really kind of like all in on childcare right now.
Hi, everyone. I'm Alex Malamatinas. I'm the founder of Melitas Ventures. We're a New York-based venture capital fund that invests in early-stage, better-for-you branded products focused on food and beverage. So companies such as Magic Spoon, Mudwater, Verb Energy, Kin Euphorics being some examples. We invest primarily in better-for-you branded products, but we also invest throughout the ecosystem. So ingredient innovation, food tech, food science. We're very focused on trying to be early in these structural trends and categories. And right now, we're particularly excited about the gut health category, need state products, and particularly within supplements. And also really trying to focus on Gen Z. There have been some incredible brands that have been built over the past few years focused on millennials. And so we're spending a little bit more time trying to understand Gen Z.
Great, thank you. So Alex, you mentioned something, you mentioned about trying to get in early at brands. What are the characteristics of an emerging brand that you're focusing on and really pop for you right now?
Yeah, it's a good question. So, there's a few different criteria that we'll look at. Some more qualitative, some more quantitative. I think from the qualitative side, finding something that's truly unique and differentiated about the brand and a voice that's authentic. It's perhaps speaking to a demographic that's otherwise not been previously spoken to, whether it's, what Mudwater did for the coffee alternative drinkers, or what Liquid Death is doing right now. So I think in terms of the brand, it's something that has to be very carefully nurtured, but something that's truly authentic and speaks to its customers. Obviously, finding very talented founders. I mean, perhaps the single most important criteria. And no founder can do everything him or herself. But understanding what their strengths are and what they need to build a team, I think, is really important. And for us, it's really a partnership with the founders. It's sort of a two-way process. Are we going to work together well? We're going to be in this for quite some time. And then from the financial perspective, I mean, it's obviously quite limited in the early days. We invest in seed Series A primarily, but we do typically look for some initial revenue traction. So even with a few months of data, you can get a sense of what the sales trends are, what the underlying, say, sales velocities are, what retention is, what the margin dynamics are, like what's the gross margin, what the contribution margin, because that in particular doesn't, or it doesn't change much over time, and it's difficult to improve.
Yep. Jesse, how about you? What are you focusing on right now?
In terms of our portfolio?
Yeah, in terms of your portfolio, and then I think some of the things that Alex was talking about, like, what are the characteristics of a brand that you would invest in right now versus, what's maybe a pass for you?
Yeah, I mean, I think right now is a different time. This is like the test of humanity when it comes to entrepreneurs and entrepreneurship. So we're where we used to be living in this like Uber generation where valuations were high and revenues didn't meet the valuations in any sense. It was like this big balloon. Now everyone's made that shift, and we are so hyper focused on profitability. They say there's these markers for like a Series A round. Like you should be doing $1 million in revenue, for example. We're seeing that now be closer to $2 million in revenue. I think investors are also, the control is a little bit back in the investors' lap, where it used to be the brands who could kind of dictate the founders who could dictate the valuation a little more. And obviously, it's a negotiation, so there's always has to be some agreement there. But I do see now investors are bringing down valuations, and so those are some of the things that we're thinking about. And then in terms of a pass for me, I mean, I think I never want to discourage anyone from any company they're building, but like some red flags for me are when you're doing too many things at the earliest stage. I saw a company yesterday that was just trying to launch 1 million products in 1 million verticals, and this was a seed stage company. They hadn't raised any capital, and I was like, why don't you just focus on one product, one vertical, focus on your customer acquisition in one way. I mean, just make sure in the beginning you're focused. And I find that happens a lot when people come from corporate. When they come from a larger corporation, they're used to thinking about all of the things that the corporation does. But it's the opposite at the early stages. So you need to be starting slow and staying super focused.
Yeah, I hear that a lot. And Jaime, I'm curious, as a founder and probably somebody that had these conversations with investors many times, how are you thinking about that sort of feedback as a founder and as somebody kind of bootstrapping a business at the beginning?
Yeah, I mean, I certainly experienced that firsthand as a founder, that sort of desire to create everything, right? And I'm not saying you shouldn't do a lot of things and see what sticks, but I think, there's a point when you know what your unique offering is and, what you're good at and like how you are making a mark in that industry. And so I started out at the farmers markets. I had a whole range of products, soaps, shampoos, deodorants, and lotions. And I was most excited about one of those, and I knew that I was doing it in a way that hadn't been done yet. I knew there was an opportunity to disrupt the shelves, offer something that looked a little different, maybe smelled different, felt different, and that was the deodorant. So I decided to go all in on that, and I thought I can put these other things aside for now and then revisit them later based on what my customers were saying and what sort of things they were wanting. And so went really all in on the deodorant for a few years, got major distribution. I'm proud to say we were one of the first natural deodorants to go mass. I wanted to really disrupt this idea that natural belongs in Whole Foods and naturals stay at the farmers markets, right? I thought they belonged in Costco, Walmart, Target. I wanted everybody to have access. And so I really went all in on that. And once I had that distribution and once I had the loyal customers, that's when I thought, okay, it's time to really think about how can I expand on this product line? What can I do next that makes sense for me and my brand? So there's a lot of strategy there, but the deodorant, still remains the number one. It's that first product that's always, your hero, I think.
Yeah, that's really interesting. And so, I guess what advice would you have for a brand going into a meeting with an investor? What would you try to highlight, and what are some of the things that you hear from brands that feel like are a distraction from the conversation and kind of trying to move forward with an investment? Maybe Alex, you want to take that one?
Sure. So I'll build on some of what I was saying before. I think as a brand, I mean, it's got to be authentic, right? I think as the founder, you've got to truly believe that your brand needs to exist, because I think if you don't, then it's going to be very hard to sustainably convince others. And I think the reality is there's so many products out there today that there needs to be an element of differentiation, whether it's the brand and or the ingredients, the positioning. And I think to Jesse's point, you need to be really clear and focused, particularly at the beginning, because you have limited budget, you have limited attention span from consumers, and it's just too difficult to do too many things at once. So do one thing, own it, and do it very well.
Can I add to that?
Yeah, please.
You know, one thing I learned actually the hard way in pitching retailers is that you want to talk about how your product is different and how you're going to add value to the category as a whole, not how it's better than the competition. I remember being in a meeting at Target and saying, oh yeah, we're going to outsell Tom's of Maine in year one, no problem. And the buyer looked at me and said, that's great, but like, how does that help me, right? Like, how does that bring in more revenue to the store? And then it clicked. I thought, okay, yes, like the Tom's sales are going to remain consistent, and then Schmidt's is going to come in, and we're just going to add more revenue to that category. And so that is very, very key, just to really think about your unique place in that category and on those shelves. And then also fast forward to my acquisition, you know, in entering the Unilever family of brands, that same concept applies. There were other brands of deodorant, you know, in their portfolio, but Schmidt's had to make a case for how ours was complementing those, right? And not detracting from those sales. Yeah.
I mean, I love what you said. She obviously, you know, she sold her company to Unilever. I don't know if you announced that. She's a total badass. One of the things I think of as an investor is like, if you're coming to me with an all-natural deodorant company, we have one as well, you know, you need to make sure you have a moat or something proprietary that you can prove to me. You, as a founder, you should look at it like, what are my 3 key differentiators in this space that make me incredibly unique? Like, is that your, you know, your distribution? Is that your, like we have a company called Tea Drops that hopefully is here somewhere today, and they're patent pressed tea. They're, you know, they're bagless tea. So that was very unique and different. And they had patents around it, and it's delicious. You should try it. Shameless plug. But those are some of the things that we think of. It's like something, you know, just what's different and unique to your company. And you should just approach an investor and be like, here's what makes me different. Sorry.
The storytelling piece is so key there too. You know, back to the retailer meetings, you walk in with just a story about who you are, what inspired you to start your brand. And I saw like the buyers' faces just sort of light up, and they were really refreshed, you know, to hear my story after having talked to, you know, some of the corporate brands that had been in there right before me. And so always own that story. It's way more special than you might think. You know, your unique, you know, background and journey to starting your company is it holds so much value. And so like never hold back on sharing that.
Yeah, I think that's all really good advice, and I think in this kind of fundraising environment where things are pretty uncertain, it's key to really find a way to kind of pop. I think on that theme of this being an uncertain environment, how are you advising portfolio companies or companies you're advising or you know, other new brands to think about runway and how much cash to plan for? I've been hearing from experts that we should be, you know, preparing for maybe a 24-month or even 36-month downturn. What does that mean in terms of how much money a brand should be looking to raise, and how has that changed, if at all, over you know, over the last 6 months, 12 months?
Happy to jump in on that. So I think. I mean, the first thing, you know, any company should consider in an uncertain macro environment is extending cash runway. And you know, you can do that by raising more capital. You can cut costs and improve profitability. And I think you should be looking at all of your options. And I think, generally speaking, I mean, it will depend on the company. And nobody, I think, has a perfect crystal ball on the macro. But generally being prepared for a worse outcome. So again, generally speaking, I would say, you know, if you have 24 months of runway, you're in pretty good shape. What we're advising some of our companies is, take in more capital than you need in the current round, and maybe even the previous round that you've closed, bring in investors at the same terms, because it's critical, again, to survive, to be able to execute on your business. And founders are being more sort of mindful about that rather than optimizing for valuations, which I think can be quite dangerous.
Yeah, I agree. I mean, 24 months of runway, and also, like, I look at Jamie's company, and she bootstrapped that whole thing. If you can bootstrap as long as you can, I mean, then you have, like, your destiny's in your hands. I think many people need to raise. There's also a lot of other options for brands right now. You could open a credit revolver so that that's also non-dilutive capital for you as a founder. So you'll own more of your company. Usually you can find those once you have about $1 million in revenue, and like an inventory revolver of some sort. So we're seeing that a lot more. And then a couple of months ago, there were a lot of these articles that said, like, the flat round is the new up round. So, like, valuations typically go up, but I think as valuations are coming down, we do see more companies raising these bridge rounds at sort of flat valuations. And as founders, you shouldn't feel like that's a fail in any way. It's just like you have to get to where you need to go. And so those are some of the things that we're seeing in terms of that.
I would add, if you are bootstrapping, it's still really important to know, how you would get capital if you suddenly really need it. Whether that's a line of credit, or some other kind of loan, but also really knowing the investor scene, right? Like, know who you would raise from if you wanted to. Start forming those relationships, because relationship building does take time. And so even with, within the next couple of years, if you're like, I got this, I'm going to bootstrap, just know who you would approach when you need to. And then when you do start to fundraise, like, definitely know what you're going to use the money for. I've seen a lot of founders walk into a meeting and say, I need money. And, we ask for what? And they're like, for everything, and that's fair. But as investors, we want to know, like, what our capital contribution is going to go towards specifically. And so have an idea, as much as you can about, like, what those specific funds are going to go to.
Yeah, I hear that feedback a lot from our clients, that the feedback they get from investors is, tell us exactly how you're going to use this $2 million that you want to raise. So one thing that I think you all brought up was the topic of valuations, which is everybody's favorite question, especially in an environment like this. What is your advice to a brand in terms of how to even approach that conversation? At what point in a dialogue with an investor does it make sense to start talking about valuation? And how do you propose a valuation? How should you, what should you come to the table with in terms of substantiation for what you're proposing? And what sort of advice do you have for founders on that?
I think people like to say it's this beautiful, perfect art to find your perfect valuation, but it's actually all kind of bullshit, if I'm being honest. It's like the investor wants to push your valuation down because they want to own more of your company, and you want to push it up because you want to own more of your company. So you need to come to a nice medium. There are comparisons in the market in terms of when that you can look at, in D2C, in your specific vertical. You should see, what multiple on revenue, is it like a 3x multiple on revenue, and you can value your company based on that, also based on any patents you have and any, brand recognition. That'll help your valuation go up. And the team, have they operated before? But I mean, we take all these things into consideration. And usually you talk about that in the beginning, certainly with a potential lead, like, hey, I always try to just throw it out there and say, where were you thinking valuation was going to be? And it's pretty rare these days that someone's way off, but that does turn me away. Like, if they're like, I don't have a product yet. I mean, this does happen. I don't have a product yet. I'm, this is what it's going to be. And then they're like, it's a $50 million valuation. I mean, I was talking to a GP about this, and they're like, Tesla had a car at a $50 million valuation. So like, be realistic, you know?
Yeah, I think just building on Jesse's comments, I think clearly there's two sides to this, right? And so from the founder side, typically what the founder is trying to optimize for is ownership and minimize dilution, and the investor is trying to get the lowest possible valuation and maybe using the lowest multiple to get to that valuation. And I think ultimately, you know, factoring both of these things in mind, you just have to have an open and an honest conversation about, look, this is the business. This is how, you know, other companies are valuing their DTC side of the business. We're thinking about going into retail, so maybe it should get this multiple. This is, you know, the sales we generated last year. This is the sales that we generated this month, and this is what we can extrapolate going forward. And again, it's not a perfect science, but at least coming to some common understanding of this is how we get to the valuation, rather than, oh, I want a 50 million valuation because I have a great company.
And I think an important part of that candid conversation is being able to speak to your weaknesses as a company and knowing what you need help with and knowing where you kind of suck, right? Like, I am failing in this part, or I really need help here. And so that is all part of the investor conversation. It's not always like, here's why I'm awesome. Here's why I deserve X amount of dollars. It's also like, this is where I really need some help.
Yeah. Are there other attributes of companies, you know, outside of financial metrics, outside of brands? For example, I've been seeing the themes of sustainability and an ethical brand and kind of other themes that seem to be becoming more of a focus for brands. How are you thinking about those themes in investing, and you know, what does that mean to you when a brand says it's sustainable, and how do you measure the authenticity of that?
Yeah, we're seeing. Do you want to go ahead? We're seeing a lot more sustainable. I mean, everything should. If you are not a sustainable brand, you should be thinking about how you can be a sustainable brand. You know, you were saying you're doing a lot on millennials. Like studying kind of like what they're looking for in Gen Z and what they're looking for, and they don't want to buy anything that you know, they don't know where it came from or the story behind the brand. Now there's so much data and research around that, so like, you know, you want to make sure. Something that like does keep me up at night is like it's very specific, is polyester. Like, that's just so bad for the environment, and like that's in every type of clothing, and we're in some companies that uses it regularly. And I don't know if you can solve that problem. That's one problem I think about a lot. But yeah, I think sustainability is incredibly important. The climate's incredibly important. We're looking for water companies, desalination companies. You know, we need to save this planet. And also, as a VC, you should be looking 10 to 20 to 30 years down the road. And like, we're screwed in like 10 years, I think. And then we're really screwed in 20. So any wild and crazy solutions there, come pitch me.
I think it's important to note that like not every brand can save the world, though, and I think we have to be realistic in that. I think as much as we can be sustainable and responsible and authentic, like that's all very, very important. But if your company is, you know, not in a position or in a market where you can do that, or it doesn't make sense, like that's okay. You can still run your business in a way, like I said, that's responsible, you know, and you're giving people jobs and you're bettering your customers' lives. And if you impact one or two people, you know, that still is, you know, an influential business. That's important. And so I think a lot of founders do stress, like, how do I build that sustainability story? How do I show that I'm like having this huge, major positive impact? And it's not always going to be the case, and that's okay. Your story will be really personal.
Yeah, thanks for that. One other thing I was wondering, and again, a question I get from a lot of our clients at our law firm is, I went out to the market, I tried to raise money, and there's no one biting. What is your advice to a founder that is in the position of, you know, growing, doing a great job, doing everything right in their mind, but isn't finding the level of investment they need to keep growing at that moment? I think, Jesse, you mentioned trying to access debt financing. What is your advice for a brand in that position and how they can navigate that?
I would just say two things you can do. First of all, if you're saying that as a founder, I would first say, how many investors did you talk to? And often in that situation, they'll say, well, I spoke to 8 VCs. And I'll be like, okay, cool. Speak to 100 and then come back to me and make sure they're very targeted. And then also go back to some of those and say, can you give me some feedback? Because maybe there's something you're not seeing that you can address on a page in your deck so that it's no longer an issue. And those are the 2 things I'd recommend doing.
Yeah, I totally agree with that. I mean, at the end of the day, capital raising is never easy, let alone in this environment. And so, one of the key things we look for in founders is grit. And, you just have to keep going. If you believe in it, keep trying. And, there are many successful founders that have had hundreds of rejections, and then ultimately they find the right investor and they build very successful companies. So, just keep going. And sure, there are ways, getting working capital lines, debt sort of solutions. And these are all things that help sort of buy time. But ultimately, you've just got to keep talking to investors and clearly convey your vision and passion for your company.
I always think of those moments as like an opportunity to reset, right? Like take a step back, reevaluate like where you're at in the business, and maybe it's not the right time, and slow down. Like it's just an opportunity to sort of check in with yourself and to make sure that really is the right time to be raising capital.
Yeah. I think that's that opportunity to take a step back and reassess and refocus is really crucial. One other thing I've been hearing a lot of is that institutional investors, but investors in general have a lot of dry powder right now, but there's not necessarily a lot of deployment of that dry powder, and that's obviously a function of the market we're in. Do you agree with that? And is that what you're seeing in your own investing activity right now? And how long do you think that lasts for? Is that, as long as this uncertainty in the market continues, or is it until founders get realistic with the valuations they ask for, or some combination of those things? Where do you see that going over the coming months and year? Maybe start with Alex.
Sure. So yeah, from our perspective, I mean, we're very aware of the macro, but we don't try to time the macro. I mean, we look at each company, on an individual basis, and if the opportunity is right because the founder is great, the product's great, and the terms are reasonable, and we have visibility on the sales, we'll make the investment. So we don't sort of take extreme views. I know some funds sort of take a hiatus and they don't invest, and then they invest, and there's no right and wrong, but that's our approach. I think there is a lot of dry powder on the sidelines, and as the macro visibility improves, you will likely see more activity. So it's very difficult to know when that happens. There's a war in Ukraine. There's uncertainty about inflation and interest rates. So as we start to get visibility on these things, I think you'll start to see more activity. And again, this is cyclical. It's happened many times before. But ultimately, if you believe in the structural trend, my view is you just got to be very mindful of the valuations and the opportunities and just stay focused.
And I think it's like your opportunity to talk about why right now is the right time. I think that's good advice in general when you're raising capital, is to say like, why now? But especially why now, right? Like that's your opportunity to really make a story.
Yeah, I mean, I think there is dry powder, but I think also investors are being pickier. But also, you can take control back as a founder. I'm sort of like just assuming there's more founders here. So if I'm wrong, are there a lot? Raise your hand if you're a founder. Okay, I was right. There is dry powder, but I think you can take the control back too by being thoughtful about and deliberate about what investors you're talking to. And you can actually ask questions and say, are you deploying right now? When are you fundraising again? Because when you team up with an investor, you also want to make sure they have follow-on funding for you. And you want a really supportive investor with a substantial amount of dry powder right now.
Jaime, Jesse, Alex, thank you so much for these amazing insights. And For all of the founders out there, I would encourage you to use these 3 as resources.
We can do questions. Does we have a few more minutes, like
Okay,
extra. Are you guys okay with that?
Yeah,
Does
right.
anyone have a question? I'm going to bring the mic to you. Okay, then I'll go there and there. All right.
Hi, thank you. Very, very timely panel. I think a lot of the founders here are going to really benefit from it.
Can you speak a little bit louder? I'm having
Yeah.
trouble hearing you up here.
I was just saying thank you. It's a really timely panel. So let's address the elephant in the room. All these companies that are kind of at the bottom of the J curve, they're good companies, tons of promise. They've done $1 million in sales. They've found product market fit. They can't get funded right now. What's going to happen to them? Like I asked this from a selfish standpoint. I have 20 early stage CPG investments, great companies. There are going to be companies that can't get funded. Like you addressed it a little bit, that we're in a new paradigm, but we're in a paradigm we haven't seen in 20 years. I'm asking like practically, logistically, what happens? Do these companies sell their assets? Do they sell their IP? Do they get consolidated? Or do they just disappear and go away and it's creative destruction and from the ashes rise the good companies?
I would love to talk to you about this. I have a lot of wild and crazy ideas. They may not be correct, but I would love to talk about the idea of roll-ups and like going to PE funds who are vertically, like a new home decor brand, PE fund, a PE fund focused on home decor. I'd love to sell them all our sort of like home decor D2C brands, for example. And I think we're going to see a little of that. I think we already are. I think the SPAC era is still kind of going, and we've seen a little bit of that. But I think that's what I'm thinking about. And you are seeing new PE funds come out of the woodwork. You're seeing these, what are they called? Search funds, where, and that's like someone who kind of wants to take over a company or a few companies, and they'll buy a large stake. I'm thinking about all those things. I'd love to sit down with you. Also, Jesse at halogenvc.com if you would like to pitch us.
Thank you. All right.
Hi there. Hello, sorry. So we are a high-end on-land swimwear brand. We did $3.5 million over the last 18 months, which is our first 18 months. But we are now in the process of starting the process of raising capital. We are coming out of our seasonality, and I wanted to know whether or not you feel like timing to that level is important. Do we hold off on raising capital until we're back in spring and on an upswing, or are we okay to have these conversations when we know that our numbers for the next couple of months would be much smaller than they are in summer?
I mean, if you're coming off a great moment, I think that's really a good time to raise. Are you going to make it? I think that's like, do you need the money now? Go after the money sooner than you need it. I think you can talk about what's happened and your projections. Are you profitable? He's like just sharing his numbers. Yeah, good job. Good job. Yeah, you're ahead of a lot of them right now.
All right. We have one more and then we're going to wrap.
Hi, my name is Val Yukovchik. I founded a company called MoxieLash. First to market magnetic eyeliner and magnetic eyelashes back in 2018. My question is for you, Jesse. You mentioned that 8 VCs, not enough. Go speak to 100. How do you find 100 VCs?
Okay, conferences like this, I think about that in terms of LPs because I also have to raise capital. And so I would just be out and about every tech event you can find. Find founders, like founder friends, and do a trade. We have a lot of our founders do that. And then just blow up their LinkedIn. Just like blow it up. And those are a couple suggestions.
All right. Well, thank you so much. Give it up for our panel.